Hey, thank you for watching Finance and Wealth Matrix channel. I am financial strategist, working in wealth management for more 20 years. All my videos on this channel is about finance and how can maximize your saving in this era.
You get paid on Friday. You check your bank account, the deposit hits, and for a second, it looks fine. But then you pull up your pay stub, and there it is. The gap between what you earned and what you actually got. 25 to 40% of everything you worked for this week, gone before you touched a single dollar of it. Now, most people see that and think, okay, income tax, Social Security, Medicare, state tax, I know the deal. And yeah, those are real. Those are on the stub. You can see them. But there's another tax. One with no line item on your pay stub. No politician voted for it. No bill was ever sent to you. And depending on your income, it is quietly stealing anywhere from $4,000 to $15,000 from you every single year. That's what this video is about. Most people think inflation just means groceries cost more or gas is expensive. And that's true, but that's the surface. That's like saying an iceberg is a little chunk of ice floating in the ocean. What I'm going to show you today is what's underneath. 3 specific layers of a hidden tax system that almost nobody talks about. Exactly who is benefiting from it at your expense, and 7 concrete moves to start fighting back. Once you see all 3 layers, you will never look at your paycheck the same way again. Let's get into it. So the common understanding of inflation is this. Prices go up. Your eggs cost more. Your rent went up. Your car insurance doubled. That's inflation, right? Technically, yes, but the real damage isn't in the price tags. The real damage is in what your money can no longer do. Here's a simple example. Say you were making $60,000 in 2020. By 2026, it was roughly 23%. So while your number went up 11.6, the cost of your actual life went up 23. You didn't get a raise. You got a pay cut dressed up as one. Economists call this the money illusion. The number goes up, so you feel okay. But your actual wealth-building power is going backwards. Lifestyle feels the same. Buying power is shrinking. And because nobody sends you a bill for it, most people never connect the dots. Now, here's where it gets uncomfortable. This isn't an accident. Moderate inflation is actively preferred by governments and large financial institutions. And there are 3 very specific reasons why. Reason 1, it erodes government debt. The US national debt is over $34 trillion. At 3% inflation, that debt shrinks in real terms every single year without the government paying a cent extra. Think of it like a fixed-rate mortgage. If inflation rises, the real value of what you owe gets cheaper over time. The government does the exact same thing, except they have the ability to influence the money supply. Result, their debt burden gets lighter. Your savings take the hit. Reason 2, asset owners win, wage earners lose. Inflation destroys the value of cash, but inflation increases the value of assets. Stocks, real estate, businesses, commodities. If you own things, inflation works for you. If you hold cash, inflation works against you. This is not a conspiracy. It's just how a fiat currency system naturally operates. Rich people own things. Inflation makes things worth more. They get richer. Middle class earn wages. Inflation erodes wages. They fall behind. The wealth gap isn't just about income. It's about what form your wealth is in. Reason 3, banks profit from the spread. Right now, the average savings account in America pays somewhere around 0.5 to 0.6% interest. Meanwhile, that same bank charges 7 to 8% on mortgages and up to 25% on credit cards. That gap is billions in profit. And the bigger the spread between inflation and your savings rate, the more purchasing power quietly flows from your account into the financial system. Every single day your money sits in a low-yield savings account, you are subsidizing the banking system. Not investing in it, subsidizing it. That's the system. Now let me show you the 3 layers of how it actually hits you. Layer 1, the inflation tax on your savings. Right now, if you have $50,000 sitting in a regular savings account earning 0.5% and inflation is running at 3.2%, you are losing approximately $1,350 in purchasing power every year. You're not gambling. You're not being reckless. You're doing the responsible thing, saving money, and the system is penalizing you for it. The so-called high-yield savings accounts that got popular a couple of years ago, they peaked around 5%. As of 2026, most have dropped back to somewhere between 3.8 and 4.2%. Still better than nothing, but barely keeping pace with inflation. And most people aren't even in those. Most people are still in the basic account, losing ground every month without realizing it. That's layer one. But if that was the only layer, you could fix it pretty quickly. The second layer is where it gets sneaky. Layer two, bracket creep. Almost nobody outside of finance talks about this, and it might be the most quietly damaging thing happening to working people right now. Here's how it works. Every year, the IRS adjusts tax brackets for inflation. Sounds fair, right? Except they use something called chain CPI to make those adjustments, and chain CPI consistently runs lower than actual inflation. So here's what happens. Your salary rises 4% to keep pace with inflation.
The tax bracket only adjusts by 2.8%. That 1.2% gap pushes part of your raise into a higher tax bracket. Real example. You're earning $85,000. You get a 4% raise, taking you to $88,400. But the bracket only shifted for 2.8% inflation. That means roughly $1,032 of your raise is now taxed at a higher rate than it would have been if the adjustment was accurate. 1 year, that's annoying. Over a 10-year career, that quiet miscalibration costs you an extra $3,000 to $8,000 in taxes beyond what you'd reasonably expect to pay. No debate, no vote, just quietly happens every year. And that's still only layer two. Layer three is the one we do to ourselves. Lifestyle inflation. You get a raise. Inflation eats some of it. Bracket creep takes more. And then, almost automatically, the rest gets absorbed into a slightly upgraded life. Nicer apartment, newer car, more subscriptions, better restaurants. None of it feels like a bad decision in the moment. Each upgrade seems earned. But let's run the actual math on a $5,000 raise. Inflation eats $1,800 of real purchasing power. Taxes take another $1,200. Lifestyle upgrades absorb $1,500. Net wealth gain from a $5,000 raise? $500. And most people don't even invest that $500. The hidden tax isn't just coming from the government, it's hitting from every direction at once. And fighting it requires understanding all three layers together. Now, let me show you exactly what this looks like in real numbers, because I want you to see where you fall. 3 income profiles. Profile 1, $55,000 salary, $8,000 in savings. Inflation tax on savings, negative $216 a year. Purchasing power loss on salary, negative $1,100. The tax bracket only adjusts by 2.8%. That 1.2% gap pushes part of your raise into a higher tax bracket. Real example. You're earning $85,000. You get a 4% raise, taking you to $88,400. But the bracket only shifted for 2.8% inflation. That means roughly $1,032 of your raise is now taxed at a higher rate than it would have been if the adjustment was accurate. 1 year, that's annoying. Over a 10-year career, that quiet miscalibration costs you an extra $3,000 to $8,000 in taxes beyond what you'd reasonably expect to pay. No debate, no vote, just quietly happens every year. And that's still only layer 2. Layer 3 is the one we do to ourselves. Lifestyle inflation. You get a raise. Inflation eats some of it. Bracket creep takes more. And then, almost automatically, the rest gets absorbed into a slightly upgraded life. Nicer apartment, newer car, more subscriptions, better restaurants. None of it feels like a bad decision in the moment. Each upgrade seems earned. But let's run the actual math on a $5,000 raise. Inflation eats $1,800 of real purchasing power. Taxes take another $1,200. Lifestyle upgrades absorb $1,500. Net wealth gain from a $5,000 raise? $500. And most people don't even invest that $500. The hidden tax isn't just coming from the government, it's hitting from every direction at once.
And fighting it requires understanding all three layers together. Now, let me show you exactly what this looks like in real numbers, because I want you to see where you fall. 3 income profiles. Profile 1, $55,000 salary, $8,000 in savings. Inflation tax on savings, negative $216 a year. Purchasing power loss on salary, negative $1,100.
1,220. Purchasing power loss, negative 2,800. Bracket creep, negative 3,200. Lifestyle inflation, negative 7,000. Total hidden tax, nearly $15,000 a year. And here's the number that should stop you cold. Profile 3, over 30 years, loses over $730,000 in compounding wealth. Not from bad investments, not from bad decisions, just from not understanding and not defending against the system. Now, before I get into the defense moves, I want to know where you fall. Drop your gross to net gap in the comments. Just the percentage. You don't need to share the actual numbers. Because I think most people have never actually calculated it. And seeing it written down changes something. All right, 7 moves to fight back. Move 1. Stop keeping excess cash in a regular savings account. Anything beyond 1 month of expenses should be in a high-yield savings account or short-term treasury bills through treasurydirect.gov. No risk, no complexity, just stopping the bleed. On $30,000, the difference between 0.5% and 4.5% is $1,200 a year, doing nothing different except where the money lives. Move 2. Max your tax-advantaged accounts first. Your 401k limit is $23,000. Roth or traditional IRA is $7,000. HSA, if you have a high deductible plan, is $4,150. That's up to $34,150 per year that can be shielded from bracket creep. And if your employer offers a 401k match and you're not hitting it, that is free money you are leaving on the table. Full stop. Move 3. Invest in assets. $10,000 in real terms today. $10,000 invested in the S&P 500 in 2000 is worth approximately $78,000 today. The S&P 500 has returned roughly 10% nominal annually, about 7% after inflation. A savings account loses about 2.7% in real purchasing power every year. You don't need to pick stocks. A total market index fund, automatic contributions, consistent over time, that's it. Move 4. Own assets that are built to beat inflation. I-bonds have an interest rate tied directly to inflation. TIPS, Treasury Inflation Protected Securities, have their principal adjusted with CPI. Real estate prices and rents rise with inflation. REITs give you real estate exposure without being a landlord. These aren't growth plays, they're inflation shields. They exist specifically for this. Move 5. Negotiate your salary against your personal inflation rate, not the official CPI number. Official CPI almost always understates what your actual life costs. Before your next review, calculate your own rate. Look at your housing, food, insurance, and transportation costs compared to 2 years ago. That real number is the minimum you should be asking for just to stay even. Anything below it is a pay cut with extra steps. Move 6. Attack lifestyle inflation deliberately. Every time you get a raise, audit the upgrades. The rule I'd suggest? Take home goes up $400, $280 goes straight to investments, $120 goes to lifestyle. You still feel the raise, you build wealth with most of it. The ratio matters more than the amount. Move 7. Build income that grows faster than inflation. A salary is capped. It's tied to your time.
3 forces hitting you simultaneously, every year, from every direction. The 7 moves to fight back. Move excess cash to high-yield savings or T-bills. Max your tax-advantaged accounts. Put money in index funds. Own inflation-resistant assets. Negotiate against your personal inflation rate. Apply the 70% rule to every raise. And build income that scales beyond your salary. If this video shifted how you see your paycheck, the next one is going to be just as important. I'm going to go through the exact accounts and specific assets to stay ahead of inflation. Not in theory, in practice, with real numbers. Make sure you're subscribed so you don't miss it. And if you know someone who's been grinding, doing everything right, and still feels like they're falling behind, send them this video. Because chances are, they're paying this tax too. They just don't know it yet.